Hello, everyone. Thank you for joining us for today's webinar. My name is Quinton Moorhead. I'm the National Account Manager of Top Crop Manager of Potatoes in Canada. I'm joined today by Eric Olson and Kim Geringer. Today, during our session, Eric and Kim will discuss utilizing benchmarking, touching on topics such as why it's important, COVID-19 impacts on data metrics, as well as a live demo. Thanks to M&P for sponsoring our session today. M&P is a leading national accounting, tax, and business consulting firm for Canada's agriculture industry. We have invested more time and resources into understanding agriculture than any other firm, with more than 18,000 agriculture clients and a team of more than 600 agriculture specialists. M&P delivers a diverse suite of services to protect farmers and maximize results. This webinar is being recorded and will be made available to all attendees and registrants approximately 24 hours after our live broadcast. This session is scheduled to run for approximately 45 minutes to an hour. Eric and Kim will speak for about 45 minutes, and following the presentation, we'll open the floor to questions. If you have any questions throughout the presentation, please type it in the questions tab found on the GoToWebinar panel of your computer screen. This webinar has been approved for 1 CCA CEU in professional development. Further instructions for submission will follow the presentation. Without further ado, I'll let the guys take it away.
Thanks, Quinn. Maybe I'll introduce myself and then I'll let Kim introduce himself, and then we can move forward with the presentation. My name is Eric Olson. I'm a farm management consultant with M&P. I'm based out of our Winnipeg office. I've been with the firm for about 20 years, and prior to that, I worked in the financial services industry. Kim?
Thanks, Eric. Yeah, Kim Geringer is my name. I work out of M&P's Regina office as a farm management consultant. I haven't been with the firm for as many months as Eric has been years. I'm about 14, 15 months in with the firm, and it's been great. I've spent years management consulting, commercial ag lending, and farming. Coming from a mixed farm myself, I was farming till the end of 2014. And so my background brings all three facets to the work I do as a consultant, as a former lender, and a former farmer. So quite enjoy the work we're doing here, and especially this benchmark report. Thanks for the intro, Quinton. If one more thing I can leave with all of our attendees, if you have questions throughout, as Quinton had mentioned, please type it in the box. He will interrupt us with pertinent questions so we can make this very conversational. So please don't be shy about interacting in the way that you're permitted.
So let's go.
So what you see on your screen is a copy of our producer benchmark. And we put a lot of work into this every year because we know the kind of value that our clients get from it in being able to see how they stack up against not only themselves and the trend that they are on year over year, but also how they would compare with their peers. And more importantly, how they compare against the best. As Dave Cole has said, and for those of you who may or may not know who David Cole is, he is a professor emeritus at Virginia Tech. He has been speaking and educating on agriculture and farm management for about 30 odd years. And he was a faculty member at TPAP, of which I took part in years ago. And he said, and I quote, "If you benchmark yourself against the average, you will be out of business in 5 years." End quote. That always struck with me, and I've never forgot it. It's very powerful. And so that's the tremendous value that we know our clients are getting from being able to see how they stack up against the best, because that really is the benchmark as far as we're concerned. And as I've aptly described here, I believe, benchmarking, there's people who are opposed to it. I think it's a little bit maybe short-sighted to think that benchmarking isn't a good exercise. Again, something that serves as a standard. And from a verb perspective, it's to study something such as a competitor in order to improve the performance of our own operation. That to me is where the true value comes from. We decided that our benchmark for this project would be the 25 most profitable farms over a 5-year average based on their contribution margin, because it's these 25 farms that have consistently shown that they can maximize returns year over year, good year, bad year, and otherwise. And so when we want to benchmark ourselves against the best, that is the threshold that we've established here as to what would be the benchmark. A little history about it. I won't spend much time here, but it's more about why we're doing this, why it's so important, a little bit of boilerplate verbiage in our report, and then of course the people who are key in creating the report that we've seen here. Little description on how to use it. I'll try to use my mouse to point through a little bit here. In table form, we will put what is the average, because an average is still an important indicator to work from, and that line is always shown in red. So red in the table, red line on the graphs. The specific farm is always in blue. So again, a blue line in the table, blue line in the graphs. We've added another line of measurement, which is the benchmark, as I had described a moment ago. That line is in black in the table and again on the graphs. And then of course an over-under. How did your farm, the blue line, compare with the benchmark, the black line, and color-coded for ease of reference. So that's the way all the information is presented throughout this report. Makes it very easy to follow along, and to the readability we feel is much improved over last year. The aspects or the metrics that we cover through this follows our MNP financial statements in order. We start with gross revenue, and then we also target production expenses. That leaves us with gross margin, less a labor, power, and machinery cost, which is the cost of getting the job done, right? That's a true operating cost. Next, we get into which leaves us a contribution margin, from which we will deduct a land, building, and finance expense, more of an overhead, which then gets us to an earnings from operations. We also do 3 balance sheet metrics in this report: a working capital per acre, term debt per acre, and then principal and interest per acre. We won't touch on all of these today. I don't think we're going to have time, but that is the crux of it. And part of the reason that we follow this mantra, or this order of metrics that we calculate, is because of the way our financial statements at MNP are constructed in a way that is very easy to read, understand, and to really identify where our profit comes from, or is maybe hindered by.
I think we lost some audio there, Kim, on my end.
Am I the only one who lost Kim?
Oh, there we go. I think we lost
Conversational
Kim.
and have some discussion today.
Sorry, Kim, but I think we lost you for a couple of minutes there, your audio, for some reason.
Oh, I'm sorry. What was the last thing you heard?
I think we were just getting to the bottom of term debt, the term debt area.
Gotcha. Okay. Yeah, it was again, the last 3 that you see on the screen are balance sheet metrics. So most of those are income statement metrics. The last 3 are bottom balance sheet, and we use those to follow the MNP financial statements, which are constructed in a way to be very usable, very readable, very meaningful for our clients, to help identify where their profit is coming from, or potentially where it is being hampered. So without repeating myself too much, I'll stop there. And Quentin, if you could put up the first question of the survey again.
Launch that right now. So everyone should have a screen on their, or poll on their screen now. You can click one of the 2 or one of the 4, and then I will launch the results after. Just got some answers coming through here. We'll wait a little bit longer to close it up and launch the results, but. About 50% answered so far. If we get a few more answers, then I'll close it up here. Okay.
Yeah.
Are you seeing the answers on your side now there, Eric and Kim?
Yep. So we've got 50% people are saying that their main driver profit's gross margin. About the other 50% is yield, and then a small 4% or a small portion saying ultra low cost is the driver of profitability on their grain farms.
Okay, so we got about 4% for C. Sorry, what was B again?
Gross margin.
Yep, what was the percent there?
50%, and then 46% for yield, Kim.
Excellent, thank you. So nobody picked D, hey? I was in there as a bit of a lark. That's okay. Great responses. Thank you for that. I'm going to speak to that again. If we can maybe even jump to no, I'm going to save the second question if that's okay, Quentin. We're going to go through a little bit more here. Most of you got that right on the money. Yeah, yield is big. Don't get me wrong. That is an incredibly important metric when it comes to driving profitability on the grain farm. But realistically, it is gross margin. It is B, because a phenomenal yield with a minimal gross margin that is insufficient to cover your operating and overhead expenses, labor, power, machinery, land building, and finance. A big yield is great, but if there isn't enough gross margin to cover expenses, it's pretty tough to get where you need to be profit-wise. Now, that being said, it is tough to have gross margin without yield. So it is a bit of a loaded question. I don't want to discount answer A, but it is definitely gross margin is the main driver. Diving right into our report. So these are real numbers. This is a report that has been generated early for our 2020 results that we will be publishing soon. This is coming from our Manitoba colleagues. And there are 71 farms in this report up to date. The report that we will be generating in South Sask, we're going to be producing those reports tomorrow or maybe Monday. So what we see here is exactly what you will see in one of our reports. The top table, we present the acres, because it's always a question of how big are these farms that we are comparing to. Is bigger better? It's always a question mark. So we just took the liberty of putting that right in there. So the first line is the specific farm that this report pertains to. We've redacted the client name for privacy, but these are real numbers. This is a real farm, and in 2020, this farm was seeding 4,870 acres. The next line is the average of all the participants in this report. So of the 71 farms in southern Manitoba who are in this report to date, those are the average acres of those 71 farms. The benchmark farms, the top 25, you see the average acres there, and then as well as the largest 15 out of this 71 in this report, and the smallest 15, just to give some lens on size and scale and just how big some of the farms are, or how small, quite honestly. And not having dissected this deeply yet, I find it interesting that the average of all 71 farms in this report in 2020 was 4,320 acres, and the benchmark, which is the most profitable 25 farms, was 4,022 acres in southern Manitoba. So if there's a little chink in the armor of bigger being better when it comes to grain farms, I think there's the first little chink. 2020 is the next table, specific to the metrics that we will measure throughout this report, as illustrated in the table of contents. Gross revenue less production expenses is gross margin, less labor, power, and machinery is contribution margin, less land building and finance expenses is our earnings from operations. We don't go any farther than earnings from operations because extraordinary income and expenses and the ways that farmers and farm owners will compensate themselves is so very different. There's nothing standard. Whether it be wages or dividends or drawings, it's so ambiguous and so hard to keep consistent to make it a meaningful metric. So we stop at earnings from operations for the purpose of this benchmarking report. Again, term debt per acre, principal and interest per acre, and then working capital for the specific year. So the first column then is the average of everybody in this report. The second column is this specific farm measured against the benchmark, again, the top 25 over a 5-year average, the variance, and then of course the rank. So this farm in particular had a gross revenue of $473 an acre in 2020, $89 below the benchmark, just a few bucks below average, ranking them number 37 out of 71. So just in the bottom half on yield. pretty consistent through production expenses and gross margin. Again, right about that midpoint of the 71 farms in this report. Labor, power, and machinery, a little higher than the average. They're down in approaching the bottom third. Contribution margin, again, very close to average, but a little below. A very solid overhead expense, land building and finance, well below average and well below the benchmark, and gets them at or about near the midway point for earnings from operations. So probably not the best year for this farm all in all, but we will know that more as we dig into each metric in the following pages. The next table, same metrics, same measurements, same columns. The only difference is now these are 5-year average. The reason we want to include 5-year average is because to try to extrapolate enough good usable information to make management decisions on a 1-year report is really leaving things short. It could be a banner year, it could be a horrible year. So when we can evaluate 5-year average and then dig into the trends of each of those expense and income metrics, it's really a lot more usable, because we all know, we've all been farming at one point or another. Good years come, bad years come. 1 year in isolation really doesn't tell us everything that we would like to know. So the first metric, and again, we won't go through all of them today, just out of the for the sake of time, but we start from the top, and revenue is it, right? So gross revenue on the farm, straight up, it's yield times price. It's not a complicated metric. We'll take total yield times total price divided by the acres and break it down into a gross revenue per acre metric for this this page of information here. Again, as mentioned off the start, in table form, highlighted in red in the first line in the table is the average of all the 71 participants in this report to date. The next line is the blue line. Again, that's always the specific farm, the black line being the benchmark, and then the over-under. What I find most intriguing about this project is being able to identify the trends, and that's what you see in the next graphic, which is the line graph. It might look a little busy with 5 lines in there, but I don't think 5 is too much, because it's so important to have all of these in here. Again, black line is the benchmark, red line is the average, blue line is the specific farm. We've added a couple others for interest, right? So the green line you see there is the average of the highest 15 for this metric for each given year, okay? So I think it's important to also note that we aren't tracking specific farms through this report on these green lines or these purple lines in this graph here. So for example, the green triangle at the end of the green line for 2020 is the average highest 15 gross revenues in 2020. Not tracking farm, it's purely linear. These are the highest 15 numbers. We've averaged them, plotted them on that graph, on that triangle. The highest 15 for 2019, it's not the same farms. It is purely linear, okay? So that just gives you a lens as to where the upper limit and lower limit are for this specific year. The 15 farms that make up the highest 15 gross revenue in 2020 are probably not the same 15 farms that will show the highest earnings from operations. In fact, I can almost guarantee that it doesn't happen. There will be some, but it is not the same 15. We are not tracking those farms year by year through this report. The only farms that we are tracking throughout this report are plotted on the black line. The black line, as you see here for gross revenue, are the same 25 farms for each of those 5 years, because those 25 farms have been isolated because of their 5-year average contribution margin. They are the highest contribution margin in a 5-year average, and we have decided that they then have shown that they are worthy of being our benchmark, and that's how we've plotted that line. So again, the 5-year graph showing the trends, that to me is the really intriguing part. When I see the average and how it follows, the benchmark is pretty close. The blue line being this farm, if I was having this conversation with this farmer, it would be acknowledging how 2016, 17, 18, 19 has been a trend of increasing revenues. What have you done to increase those revenues? What's been happening on your farm weather-wise, crop rotation-wise, market-wise? How have you been able to go against the trend when we see the average, the red line, and the benchmark, the black line, both being fairly flat to decreasing over that same period of time? Even the green line, the highest 15 out of all 71 in this report. I mean, that's top 20%, right? Top quartile. They've shown a decline in gross revenue on the trend from 2016 in. So there's the first meaningful conversation I would be having with this client is, what have you been doing to increase your revenues over that period of time? Well done. Let's explore that. Let's keep driving it through. The final graphic you'll see on this page, and it's the same with every page, the line graph in the middle, a bar graph at the bottom. The bar graph is purely 2020. That's it. And it just gives a graphical representation of where you rank. In this case, it's gross revenue. So this farm, as we showed you in the executive summary with all the data highlighted, was number 37. You can see the blue bar highlighting number 37. Again, the red bar is the average. The black bar is the benchmark, and there's the range of gross revenue in southern Manitoba of the 71 farms taking part in this report for 2020. Quite the range, and I would encourage you to pay attention to the slope of those bars and watch how it gets steeper as we go through this report. Any questions come up yet, Quentin?
Nothing yet. No, you're good to keep going.
Okay. So we're going to jump over production expenses because, you know, that's seed, chemical, fertilizer, crop insurance. Tracking production expenses is useful if we can tie it directly to gross margin, because really, as we'd mentioned earlier, gross margin is the key driver to profitability on the farm. So we're going to jump over that for the purpose of this conversation today and go directly to gross margin. I spend a ton of time talking about gross margin because, as you haven't already picked up, it's a pretty big deal from my perspective. And so we want to make sure that everybody recognizes its importance and pays really close attention to it to try to maximize. I don't think that there's ever, I don't think maximum gross margin is what should be pursued. I think it needs to be most efficient gross margin, and we'll get into that in a second.
I got a question here, actually, Kim, if you want to stop for one.
I'm sorry. There's a question.
I got a question come through, actually, if you want to stop for one here. It
Absolutely.
might be a little off topic, but do you or have you thought about adding a benchmark for business practices, like having a strategic plan, conducting an annual SWOT analysis, having an HR plan, etc.? Our research shows a direct connection to profitability.
Great question, and that's a great idea. We haven't built that into this report yet for this year. I think that's a great idea, actually, Eric. What do you think?
I think that's something that is a good idea. You know, for the report, really, our focus has been for the last few years as we've developed this and driven this out is to get these production numbers. So, you know, again, farmers have someone other than the coffee shop to talk about these numbers, because on occasion that can be a little misleading one way or the other. But the idea of incorporating the idea of higher management and planning and looking at those results, I think is a great idea. And whoever gave us the question, thanks.
Exactly. Note is taken.
That's it for now. Oh, you know what? No, just an answer. Totally understood. Would love to help going down this road. It's Heather from Farm Management Canada, if you were wondering.
Oh, great. Thanks, Heather.
Yeah, I think we've just recently signed up into a bit of a partnership with Farm Management Canada. So looking forward to that conversation, Heather. Thank you.
Just a note, Kim, just to make it clear for everyone, that black line, when we start talking that top 25%, like that, what we're doing is tracking the people that had the best contribution margin. Am I right? All Correct. The way through. So yeah, they're going to have some aspects of their farm that are going to follow. They're going to be, you know, in this case, when we looked at the prior graph, they were close, but they didn't have the highest gross revenue. And again, they don't have the highest gross margin either. So that means that there's a mix. And that's what we find with clients, that sometimes there's just an interesting mix. And that mix is not necessarily just focused on one element of this. It's focused on all of them. And that's how we get down to that number. So I just like to, because sometimes we can get confused because we're not doing line by line. Because if you do line by line, and that's really what we've given you the information on the green line, but the line by line piece in terms of making decisions and management, you're not gonna, if you're gonna maximize your gross revenue, And then if we're working with you or Kim's working with the client and we go to their production expenses and they lower the next thing we say, okay, you're great on gross revenue, but your production expenses are a bit high next to the best. Well, in order to maximize the gross revenue, and a lot of times your production expenses are going to be higher. So it's that net mix that we're really looking for. So go ahead, Kim.
Well, and well put, and that's part of a description that I'll use to highlight many of the things we've learned last year when we put this report out is exactly that. We'll get to that closer to the end. So from a gross margin perspective, gross margin dollars per acre. So again, gross margin is simply your gross revenue less production expenses. So yield times price minus seed, chemical, fertilizer, crop insurance premiums. The total is your gross margin. Divide that by your acres, we get a gross margin dollar per acre. So again, on the average, we can see it's been fairly flat, took a hit in 2019, bounced back up in 2020. Interestingly enough, the benchmark followed about the same pattern, although fair bit higher than the average. Our top 15 a little higher yet, again, following the same pattern. But this farm, again, if you notice the blue line, bucking the trend. While everybody was flat or decreasing, this farm was increasing. So again, great job for this young person who has done a good job of identifying opportunities to increase revenue and gross margin. If this farm was increasing revenue, but not gross margin, that's another conversation. He's not necessarily making himself better. So that's why it's important to not just glean over the production expenses, but include them as part of the bigger conversation, again, with gross margin being such an important driver. The last line in the table is an extra line that's here specifically for gross margin. And there are some people who disagree with me on this, but I will keep hanging on to this because I think there's a lot of validity in it. And that's a gross margin as a percentage of revenue. Having been banking and consulting for as long as I have, I've come to find that gross margin on a grain farm in Western Canada needs to be long-term at least 60 to 65% of gross revenue in order to be and maintain profitability long-term. Now, there are some people who think that percentages don't matter because you can have $3 of revenue and $2 of or $1 of production expenses and have $2 of gross margin and still hit 65%. But $2 of gross margin buys you a whole lot of nothing. Agreed. I don't start with gross margin percentage. I start with the gross margin dollar, and it needs to be sufficient to cover operating expenses, overhead expenses, and profit expectation. When it is, or even if it's close, the next metric I look at is gross margin as a percentage of revenue, because if gross margin is insufficient yet yields are strong, there's an opportunity to find a way to be more efficient, to do a better job of converting the investment in seed chemical fertilizer into gross revenue, therefore gross margin. So it's kind of a 1-2 punch. And again, some people disagree, but that's okay. If we all agree, the world would be pretty boring. Labor, power, and machinery is another one that we spend a lot of time talking about. This is, again, the cost of getting the job done. You see it on the very first line of the description there. The cost to get the crop in the ground, off, and sold. Everything to do with operating. Lower labor, power, and machinery, or LPM as we call it, isn't necessarily the key driver to profitability. We have found that in many cases, it's not a rule, but in many cases, we have found that those farms with the drop dead lowest labor, power, and machinery also have incredibly low, almost barely their gross margin. And so we begin to wonder if the low gross margin is the effect of low labor, power, and machinery, old equipment that's probably not getting the job done efficiently or on time, or is it poor gross margin that's forcing low labor, power, and machinery? It's a chicken and egg question. We haven't quite got to the answer yet, but it makes for some good conversation. That being said, again,
Kim, I think a couple of things on the labor, power, and equipment. Just, it could be a term that not everyone on the webinar understands, because it's one that we use, and again, I go back, it's your labor cost, your custom work costs, your machinery repairs, your machinery rentals, depreciation. So it's actually that rolling stock and your labor that gets that crop in and off. So it's really important, because sometimes what you'll see in a producer, because now we're below the gross margin, is we'll have some older producers that can still have pretty good, as we would say, contribution margin, because they're when we go to the next piece, their finance is really low, they're debt free, where there might not be as efficient on this factor. So in a lot of cases, at one time when I was early in my career, we would look at gross margin as an indicator to say, well, you're really good at growing a crop, so you should get more acres. Well, now we're have a tendency to drop it down a level and say, okay, you're only good at growing a crop and getting a good gross margin. Your labor, power, and machinery isn't really in order. So that really makes sense for you then to add those production units on rental, because that means that you're more bang for the buck. The other part that I always think is interesting with this is, when you look at the trend, is we also know that producers will buy and sell equipment, and sometimes they'll have their LPM will jump up for a few years when they do a major investment, and then that's why the trend analysis is a little bit more important.
Yeah, absolutely. Absolutely. We can see how the average and the benchmark are pretty close together. The blue line and the red line are almost covering each other. In this case, the highest cost is the purple line, whereas the lowest metric for the profitability calculations was the purple line. So this is flipped in that regard. But we also have found that the lowest labor, power, and machinery is not necessarily the most profitable. So that has been a very interesting discovery that we have made, especially when we found that our most profitable farms, those who are our benchmark, aren't the lowest in LPM. They're actually right in the middle. And so they have found a sweet spot when it comes to getting their job done and what they have for their mix of equipment and leases, and how much they spend on fuel and labor and all of the cost of getting the job done. They have found a sweet spot that works for their farm. And so that is a big part of what drives their profitability. They're not the lowest, they're just the best. Again, for this farmer whose report we are looking at, that blue line is at a slight increase over the years. If you remember back to the executive summary, and if you took a close look, this farm in particular has actually been reducing acres over the last few years. I don't know this person, but I expect that he probably lost some rented land. And if he hadn't downsized his equipment on a per acre basis, that will make labor, power, and machinery increase little by little over time. So, being that he's coming in at $167 an acre in 2020, we would call that high for this part of the world. This needs to be paid attention to very soon for this particular farm, because if it continues to increase, it will just erode any opportunity he has for profit based on his revenue and gross margin figures that we had looked at here recently.
Another question here, if you don't mind, Kim.
Yes, please.
So does labor typically include the farm manager or CEO? We find a tendency that the farm manager or CEO leaves themselves out of this line. Is that an issue you've come across?
It is. We see that a lot because so many times on so many farms, and this is a generational issue as much as anything, is that farm families often do a very poor job of valuing their own labor. Often not paying themselves or not paying themselves enough. And even if they aren't paying themselves, are we even quantifying it for management purposes? And so that's a philosophical, foundational conversation that needs to be had more and more as we continue to delve into these profitability calculations. And it goes to what I mentioned earlier, in that a lot of farm owners pay themselves very differently. Some purely on dividends, some on drawings, some just make their living on the return of their shareholder loans so that they're not paying any tax personally. I think each farm will do what's in their best interests. Standardizing it is incredibly difficult, but it needs to be worked on. It's because it's important.
Kim, I think that the majority of the clients that are in this benchmark are corporations, and the majority of them are paying themselves and paying, if they have kids working on the farm, or the next generation, they're paying them. Again, it's hard for us to audit whether they're paying them fairly or not. But there's labor for the owner built into this number, and it's obvious that there is. And then hopefully the profit at the end is going to be the money they use to continue to run the business and build equity and all those other pieces of any business. But we do include it. But as Kim said, it's so, maybe I'll ask a question to the group that they can think about and they can answer is, what is the farm manager worth? We would suggest that they're probably worth more than the farm laborers, and they would be worth more than a lot of other things too, because they wear a lot of hats, and the hours of work is a lot higher than what a standard farm laborer would be. So that's really a challenge, but that's the challenge of owning a business. And so we do quantify it. Are we getting it perfect? No. But if, again, we're trying to put those numbers in.
Yeah. While we're pausing here, Quentin, I should have asked you to put up survey question number 2 before I left the gross margin metric. Would you mind popping that up if you don't mind, please?
You betcha. Gross margin. Should be up on the screen now, and we'll give it a minute or two for everybody to answer some questions, and then I'll throw those answers up on the screen again.
Thank you.
Coming in a little faster this time, just about 50% here now.
Good.
A few more trickling in here. Good. And there's that. So 65% yes by crop, 35% yes whole farm, and nothing for no, I don't calculate gross margin.
Excellent. I am happy to hear that there is nobody on this call that is not calculating gross margin. Excellent. Thanks for that. We'll have one other couple of survey questions here coming up, but just wanted to get to that one before we got too far away from gross margin. So again, labor, power, and machinery, the bottom graph, the bar graph, again, you can see how varied the trend or the farms are for 2020. On the high end, we are well north of $200 an acre spent on equipment, humans, and getting the job done. On the low end, we see a few farms that are below $100 an acre. Not being able to identify who those farms are from this report or from this perspective, I mean, internally we can, but I would venture to say that the difference in profitability between those top 10 farms on labor, power, machinery versus the bottom 10 would be starkly different. Although keep in mind that our benchmark, our most profitable farms over the long term, are very average, likely right somewhere in the middle. So very compelling stuff. The next expense category that we will look at, again, skipping over the profitability metrics in the essence of time, is land, building, and finance costs. So this is your overhead, right? So it's your land cost from a rental perspective, the improvements to owned land, your property taxes, the interest paid on long-term debt, your true overhead expenses, the expenses that will be there whether you grow a crop or not. They still have to be covered. And so breaking it down by labor, power, machinery, land, building, and finance with those two overarching characteristics is what we believe makes the presentation of our data so usable for our clients. Again, the average and the benchmark fairly close, fairly flat over the last 5 years in southern Manitoba. This farm has done a good job of controlling the land, building, and finance cost, being well below the average and well below the benchmark in through all years, and keeping it fairly flat at a time when equipment costs are increasing, therefore debt would be increasing, land rent has been increasing, interest rates, fairly flat over the course of this 5 years, coming down a little bit for a period. This operator has done a good job of keeping these overhead, the land building and finance, in check. And of course, at the bottom, you can see a wide range. The last 4 farms in that graph clearly are either paying some tremendous land rent or have a tremendous amount of debt to have pushed their land building and finance costs so much higher than everybody else, and so much higher than the average or even the benchmark. It becomes pretty compelling at that regard. This is a good time for the next survey question, Quentin. I'll be on time with this one if that's okay, if you don't mind.
Betcha. How have your farm expenses categories been trending? Up, down, flat, or you don't know? Give everyone a few minutes to answer that one. Throw that up on the screen again. A few last minute answers in here, and then I'll pull it down.
Awesome.
So 74% are trending up, 4% are down, 22% are flat, and 0 don't have a clue.
Perfect. Excellent. Well, I'm glad everybody knows how their expenses are trending. That's a positive sign. Thank you for that. In the essence of time, we're getting long here, so I'm going to jump ahead. Last metric. Some say this is the most important one because it's the bottom line as far as the benchmark goes, earnings from operations. So this is the net profit metric after labor, power, and machinery, operating costs, and land building and finance, overhead costs have been covered. So again, we can see where the average has been, the red line, over the last 5 years, flat, down, a good little bounce in 2020. Benchmark following the same pattern, although above the average. Are the highest 15 in each year, again, above the benchmark, following the same pattern. And this farm in particular, again, bucking the trend, showing an upward trend from 2016 to 2019 and a slight dip in 2020. It makes for some very specific conversations that we could have with this client in particular as to the success that they have had in driving their profits up against the trend in a region where things were difficult for a period of time. So it's very, very interesting that way to, again, trend this particular farm year over year. We can see how, again, if you remember me saying earlier, when we look at these profitability metrics, the bar graph at the bottom and the slope, and how much steeper that is now than it was when we looked at gross revenue. It just goes to show that good management is good management, and it will shine through. Poor management will always have a tough time breaking even or showing a profit, and it's those areas that need the help the most, and we work hard to try to get through with. One more metric that we wanted to look at here, and this is
1 minute here, Kim. When we look back at this, I think this goes back to when we discussed how do you use this for management, right? Is a question, and when we look at this farm in particular, we see that 2020 was a bit of a down year, and they had been trending up. And really the essence of a benchmark and one that we're doing, or if you're in a different one, is understanding that, we were going to hopefully get all the right information. But with this client, we have a lot of places where we could sit down and dive a little deeper and into some areas that then identify maybe some of the areas that are moving, trending the wrong way, and talking about how to measure it and then how to manage that to move your farm back to where it's a little more profitable. So really, if you're really, in this case, if you look at this operation, we'd say, is 2020 an aberration? Like, is it the one farm that had the area where it didn't rain, so they didn't have a crop? Or is this suddenly now going to become a trend? Are we basically going up and now down a hill? So it's those kind of discussions that allows producers to start thinking and moving and changing how they're operating.
Yeah, exactly. Well said. Thank you. Another metric that I want to make sure we touch on today is one that I spend almost as much time talking about as gross margin, and that is liquidity and working capital. I have gone on record many times saying that working capital is the lifeblood of your business. Appreciated and treated as such, because without it, you're getting the transfusion regularly, and it's pretty tough to stay afloat if you have a couple of bad years back to back. So working capital is very simply current assets minus current liabilities. Current assets is cash in the bank, grain in the bin, any deferred grain checks yet to be cashed, your accounts receivable, right? Deferred or current liabilities are any line of credit balances outstanding, any your current portion of long-term debt, any accounts payable, etc. So the difference between the two is the working capital. The working capital is what you have to operate your business for the next year, and we calculate it as a percentage of next year's operating expenses to give our clients a lens as to how much of their own money they have available to run their farm versus how much they need to borrow. And of course, the more you have to borrow when it comes to operating capital, the higher the risk you are perceived to be by lenders. And it just makes things a little bit tighter and more difficult. So more working capital is better, but you can get to a point where it's too much and it's an inefficient use of capital. That's another conversation altogether. Ideally, we would recommend that a minimum target be 50%. So that would be working capital is minimum 50% of next year's cash costs. And so that's what we've been trending here. Top lines are not colored because they aren't part of the measurement, but we did have to provide them for context. So the first line is this farm's working capital. The next line is that farm's operating expenses less amortization. Again, we're talking about the cash costs, and we calculate them through. And in 2020, this farm has got strong working capital at 1.16 times. So his working capital is 116% of next year's operating expenses. That's a very strong place to be, considering that the average is 81%, and even the benchmark, which is significantly higher than others, at 135%. Not the highest, obviously. I mean, there's a couple of farms in here that are really pulling that number up, as you can see. Somebody with over 350%. That is too much working capital. There's too much cash in the bank. It's an inefficient use of resources. That's another conversation to be had, but we won't go down that road today because there are far too many farms that are too tight on working capital and are borrowing far too much operating credit to run the farm, and therefore taking on just that much more risk. Again, we can see with this farm in particular, the blue line has been increasing year over year. That is not a surprise considering the trend line we saw in earnings from operations. This is a farm that has been increasing its profits year over year, and has been building and maintaining strong working capital. So this is a good strategy for this young farm, especially as I would expect that they're probably looking to expand on acres, being that they've lost some over the last few years. That is, in essence, what our entire report is. We include a page for some note taking, and of course our back cover. But that's it, save for a few pages that we excluded in the essence of time here today. Any more questions, please fire away. Happy to chat. While you're thinking of more questions, maybe you can even put up our last survey question at the same time, Quentin, if you don't mind.
Yeah, for sure. I guess the first one will pop this up there. See if anybody wants to jump in on that one. And we got a few questions here to end it off.
Excellent.
That looks good enough. Share that for you guys.
I'm not rich enough. Is this one of your questions, Kim?
I will admit nothing.
Conversation with them. Anyways,
So
got a few more questions here and then we can let everybody go. So first one, a common objection to benchmarking is why would I want to compare my farm to a farm that grows different crops than me and is located in a different area, better land, different water, etc. How would you respond to this?
yeah, that's a very common objection that we hear. My response is multifaceted. First and foremost, we found an awful lot where we will have farms that are across the road from each other. One who is, so if they're across the road, same soil, same weather, same crops. Really, what difference is there besides some management, right? And on one side of the road, they'll be making 50, 70, or even $100 per acre more profit per year than on the other side of the road. That's important to know because the guy who isn't making as much money is going to get left behind in the competition for the finite resources that every farm needs, namely land and humans, right? On the other side of the road, he knows he's got a leg up. He's either going to retire quicker, richer, pay off his debt sooner, or be able to capitalize on the opportunities that come when they do, because we know they come up when you least expect it. But as far as other regions and other crops and so on, my response is this. It doesn't matter where you farm, you're still taking the same limited resources. You're still taking seed and soil and air and water, and you're converting it to a crop that will generate a gross margin, cover operating expenses, give you a profit, make you a living. Everybody has that same challenge. So they're still all doing the best they can with what they've got, whether it be higher quality soil, poorer quality soil, drier weather patterns, more wet weather patterns. You're still converting those same four factors into a crop. So why would we not want to know who's doing the best job with what they have and compare ourselves against them? Again, it's like Dave Cole said, if you compare yourself against the average, you'll be out of business in 5 years. Why not compare yourself against the best? That's who we aspire to be. That's what's going to create the opportunities for us to achieve our goal, retire quicker, create a legacy for family, whatever the goal may be. There's no right or wrong, but it is comparing ourselves to the best that's going to drive that.
I always use a little line with our clients because what surprised us when we started doing this benchmark is we've got different soils. We obviously don't jump crops, like we don't have potato producers in this, which is a different type of production altogether. We have all grain clients, but we have some clients in some higher yielding areas that they might be on some of their numbers are at the top, and some of the people in that area's numbers aren't on the top of this list. But we're going to take aspects of those farms and apply them to help you make better management decisions. And I always use the same line that I use with all my clients is like when you send your kids to school in the morning, you don't hope they do average. You don't go get in there and be average when you come home. You want them to be the best. And that's really what most clients that stay in these surveys and these benchmarks want to be, is the best of what what they're doing.
Awesome. Another one came through. Any idea when the Alberta report would be available? How would a non-MNP client get access to this?
So if you're a non-MNP client and you'd like access to this, get a hold of me. I'll put you in touch with the right person to make that happen. We are open arms to non-MNP clients to be part of this. We know that there's value no matter if you're an MNP client or not. And we know that the more farms we have in our database, the more valuable the information is. So as to when the Alberta report goes out, I don't have that answer today, but a couple of phone calls I could find out.
Next one, do you typically use cash or accrual in benchmarking? Do you help clients create accrual comparisons?
Accrual.
Am I saying it wrong?
Nope, you said it correctly. No, and that's the answer. Yeah, no, there's no cash figures in the benchmarking. It's all by accrual. That is the only way to really truly understand the effectiveness of each crop year and to measure profitability.
Awesome. Another one, do you provide services for peer groups / management clubs to compare benchmarking data on an ongoing basis? If so, how can farmers find more about these services?
Yes, and again, call me. I've got a template built for some peer groups we plan to launch. hoping to actually hold a launch meeting later this month if everything goes together. We've tried twice. COVID has taken the opportunity away from us twice. I'm hoping third time's the charm. Yes, peer groups, a tremendous interest among our clients to form some peer groups, so that will be happening.
So, and to expand on the answer, we have some well-established peer groups that we've been working. About 4 or 5 years, 3 or 4 years ago, we started down the road with peer groups, and they've been really successful. We weren't sure if they would be sustainable. We've learned a lot from our producers in those groups, and I think hopefully, when we talk about peer groups, we hopefully bring something to them. But the interesting part, and I support them a lot, is learning from your peers and that social connection and that bond to understand and really dive a little deeper into the operations. So again, if you're looking for something of that, get a hold of Kim and we can sure help you out with that.
Another one, do your clients pay an additional fee to be included in the survey?
So in the benchmark, yes, that is an additional fee. It's nominal in the grand scheme of things. In all honesty, it's pretty much cost recovery for us for the time it takes to generate the reports and hold some meetings with clients to discuss the content.
Let me share the fee, Kim.
Yeah, non-MNP clients, we're charging $1,500, and we will commit to providing a report, as you had seen here on the screen, full report, not just the redacted that I've provided. And a meeting, 2 hours is about what average benchmark meeting will go to help you determine the what you've learned, what we've learned, and help you dissect the information and make some decisions from it. MNP clients will pay a little less because their information is ready for us to use. Non-MNP clients, we've got to put a little more time into making it usable for our reports. So that's why we charge a little bit more.
Awesome. And then just last one, I guess, and then we can, I got a QR code just for the people that are getting CCA CEU credits. I'm already highly profitable and cash flow is not an issue for me. Why would I want to benchmark myself against anyone?
It's a great question, and I hear that occasionally as well. To answer that, I'm going to use a sports analogy. Pick your favorite team in your favorite sport. Use the hockey playoffs because they're going on right now.
I'm from Manitoba. I'm from Winnipeg. We're a little touchy right now.
Yeah. Sorry about that. Again, pick a sport. Could be baseball, could be football. Doesn't matter. If I was going with hockey, let's say you're up 3 goals with 7 minutes left in the third. If it's baseball, you're up 5 in the in the bottom 8. Football, maybe you're up 19 points with 5 minutes left in the fourth quarter. Looks like it's in the bag, right? The equivalent of being highly profitable with strong cash flow on the farm. What do we see those teams do so often, right? They just kind of, hey, this one's easy. We got it in the bag. We go on cruise control. Maybe they try not to lose instead of trying to win. And invariably, what happens? They take their eye off the ball or the puck and end up losing, right? Even if you're highly profitable, you still want to keep your eye on the ball. Even if you've got strong cash flow, you still need to keep your eye on the ball, because strong cash flow and strong profits tend to give way to being a little more flippant with some management decisions, because we've got lots of money kicking around. Yeah, there might be $3 million in the bank account, and yeah, the debt might be low. That's fine. But that's also a good way to find yourself not profitable one day. And so that's the importance of keeping your eye on the ball, recognizing that profit is the ultimate goal, and never letting yourself slip away from that vision.
It kind of goes back to this producer we're talking about right here. As you saw that this year was a bit of a drop-off year. So it's always kind of understanding, as Kim said, to understand and make those corrections. And interesting, lots of our clients, when we look at this benchmark survey that we do, and we've actually done, I did a presentation about a year and a half ago to an organization, and they also had one of the an insurance company that offers income insurance, and they had their benchmark, and our numbers were significantly higher in terms of net income. Is because these producers are pretty motivated, because most producers that get into one of these surveys are trying to get better. They're trying to they're trying to improve. And most of our are really profitable and you know, really well-to-do. I wouldn't say well-to-do, but our profitable farms are always driving to get better, and that's almost a trait that we see in those. So being in a doing a benchmark report and being part of this just seems second nature to them.
So that being said, I didn't quite hear what were the answers on our final survey question.
Around 85% they want to be contacted.
Very nice.
Always want to be improving, and 15% said I am rich enough.
Okay, well, you know, I'm always happy to hear that we've got plenty of rich farmers in the industry. That does make me happy, because coming from a small farm, that was not the perspective I grew up with, and I'm glad to know that that was very, very flawed. Congrats to all of you for taking part today. Really appreciate you taking time out of your busy day to join us as part of this conversation. Thank you for the interaction. Thanks for the interest in this. Again, we've been learning as much as our clients have. I swear, it's been wonderful. And so just wanted to say thank you for being part.
Thanks again, guys.
Well, on that, that's the last of our questions. So if you have any questions, please feel free to reach out to Eric, Kim, or myself. If you two want to turn off your webcams, I'm just going to pull up a QR code. It's their last chance to collect a CCA CEU credit in professional development. To collect this credit for the webinar, please open your phone on the monitor and scan the QR code. If this does not work, please email your first name and last name and CCA number to topcrop@annexbusinessmedia.com, and we'll submit the credit for you. I've got a few more questions that came in about, is this being recorded? Yes, this will be sent out 24 hours after our presentation. So thanks everyone for joining, and we'll catch you next time.